John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I am a consumer credit expert and have almost 30 years of experience in the credit industry. I've spent some time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 generally recognized credit reporting agencies in the US. So today I'm going to talk about consolidating debt, specifically consolidating credit card debt, but really this can apply to almost any type of debt. You can consolidate installment debt as well. There's no restriction on the possibilities with respect to consolidating debt. But most people, when they talk about consolidating debt, they're either talking about student loan debt or they're talking about credit card debt. So really the process of consolidation is nothing more than taking out new debt to pay off existing debt. And the reason you would do something like this, you may be thinking, well, how do you win by doing that? What's the upside to taking out debt to pay off existing debt, or incurring new debt to pay off existing debt?
South.
And the answer to the question is really about the cost of the debt, and in some scenarios, converting the debt from high-risk debt to low-risk debt, which is helpful for your credit score. So let's talk about the credit card scenario. So if you have multiple credit cards, for example, with interest rates in the 17+% range, which is probably where they're going to be because that's the average interest rate on a general use credit card. Retail store credit cards can have interest rates that get considerably higher, well into the 20% range. What you can actually do a couple of things. Number one is you can open a new credit card, and some people refer to that as a balance transfer consolidation or balance transfer strategy. So in that scenario, what you would do is you would open up a new credit card that has a credit limit high enough to where you can transfer in existing credit card debt from other cards to that newly opened card. And generally, if you've got good enough credit, you're going to be able to save yourself plenty of money by doing this. A lot of credit card companies will offer these balance transfer programs whereby you can open up a new card and it'll have 0% interest, not only on any balances that you have transferred in, but also on any new purchases. And this 0% grace period, if you will, can last in some scenarios for 12 months or longer, depending on the program that the card issuer is offering at that particular time. So what you have just done, you haven't reduced the amount of debt that you have, but what you have just done is if you have converted interest accruing debt to debt that has no interest. And so it just became considerably less expensive to service your credit card debt. In fact, it just became free. So that's the good news. The bad news is that you still have the credit card debt and you still want to get out of the credit card debt. And if you're not able to get out of the credit card debt by the time that the interest-free period ends, then you may find yourself paying retroactive interest back to the day that you open the card. But the benefit of doing this, obviously, is cheaper debt, and also you have just eliminated several accounts that have balances in lieu of just the one account with the balance. And so those are all very positive things. If you have also reduced your credit utilization ratios at the same time, then it's a possibility that your credit score has gone up by doing what you did. And that's going to be an individual type of scenario where it may help one person's credit score and it may not necessarily help somebody else's credit score. So the other type of consolidation is student loan consolidation. Here's how I like the idea of student loan consolidation. Student loan debt, especially when it's guaranteed by the government, is you can't discharge it in a bankruptcy, but the interest is tax deductible. So you have that balance of tax deductibility on the interest, but if the bottom falls out of your financial situation, you don't have bankruptcy as an option. So I like the idea of either refinancing the debt if possible, or in a different scenario, taking out a new loan like a personal loan or taking out a loan out of, for example, a home equity type of an account and then paying off the debt there. So what you've just done is you've just converted the debt from essentially government guaranteed debt to normal garden variety debt with a bank. And so it's now statutorily dischargeable in a bankruptcy, but the interest may not necessarily be tax deductible, and that's going to be something that you're going to want to check with your tax person to see if that is now, if that ship has now sailed. Either way, you have fewer accounts with balances. It may be cheaper to do so, and you may have actually just helped your credit score at the same time. So if you have any other questions about debt consolidation, please feel free to drop them in the comment section below, and I'll do my best to get to them. Thanks a lot for watching, and have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.